Thanks for joining us. So I've just done a quick poll, and I'm going to do another quick poll in a minute just so I can understand who's who. Do you currently have bookkeeping in-house? Well, 50% of you do. Okay, 10% of you outsource, and 40% just do annual accounts, which is really quite interesting. So for those of you that have bookkeeping in-house, I can't determine in advance how much value you're going to get from these sessions. It really depends on your own knowledge. Certainly there might be things that you can hear in the session that you might want to actually add to and improve upon, and you can do that in the comments box. I've had a question from Vinay. Is it going to be a regular Thursday or variable? No, we're looking at variable sessions. If you bear with me, we'll get this one out of the way, and then I shall ask you all what's the good time for other sessions, and we'll try to get sessions in regularly now, maybe every 2 days or so, in order to go through roughly about 6 sessions on this. Thanks for answering that poll. I'm going to end the poll now. Share results. There you are. You can all see what the results of that poll is. And I'm just going to do one more poll.
Thank you. I think you give me sugar.
I think if anybody is there that's not muted, if they could have a look and mute themselves, that would be great before I make a start. So I'm just launching another poll for those people, just so I have an understanding of the audience before we make a start. Okay, so do you have bookkeeping software already? So at the moment, 60% have XERO. Okay, so it seems that quite a number of us, or 50, quite a number of us have XERO already. And obviously what they're hoping to do from these sessions is to learn a little bit more how to use XERO, how to use it more properly. So be interested in some of the questions that you come along with me on that. Perhaps towards the end of the session, you can pop them in chat, or we can bring you in and you can ask questions so that I can add that to some of the planning for the future. So we're 7 people don't have any bookkeeping software, and 1 person has, and I think that might be Richard, 1 person has oh no, we've got Richard on board at the moment. So 1 person has another brand of software, which of course I'm only going to be focusing on XERO from session number 3. Session number 1 and 2 would be applicable to any bookkeeping situation as far as that's concerned. Okay, so that's all done now. So we'll share those results and then stop. Yeah, we can see that there. Get rid of that. Excellent. So welcome to the first session on bookkeeping. Forgive any nervousness on my part. It's a case really of me being able to properly communicate something that I haven't done before, but I'm quite excited about doing so and looking forward to it, if I'm honest. So there we go. So we're going to start by almost looking at the end. The thing about bookkeeping is, of course, is that you need to really understand why you're doing it in the first place. We're not inventing any information when we do bookkeeping. We're actually using existing information, existing facts that are known. So what are we actually doing when we're spending all our hours, you know, attributing account numbers to all of these transactions and everything else? Well, effectively what we're doing is we're producing 2 reports. The bookkeeping programs, of course, if you go into the report section, there are tens of reports that you can extract from the information that you've put in. But essentially what we're doing is we're we're trying to produce 2 reports. And those reports are what we call the management accounts that we use to manage our business. Now, those of you who don't have bookkeeping done for you or don't do your own bookkeeping, you basically are running your business directly from the bank account. So basically, if there's money in the bank account, you can spend it, and if there's not money in the bank account, you can't. And if you need to make a decision as to whether or not you can invest, or whether or not you can afford to go through a refurbishment or a repair or something like that, your decision is based purely on that bank balance and anything that you happen to know in your head in terms of what might be coming in and what might be going out in the near future. What bookkeeping does is it crystallizes that situation and actually tells you, alongside the amount of money in the bank account, actually what your business performance is, and gives you a much clearer indication of what's going to happen over the next 6 weeks with regard to that bank account. So it puts you in considerably more control. Is there someone just muting somebody there? So that's the purpose of it. So the management accounts, which is the profit and loss and the balance sheet that you get, is much more secure additional information to help you run your business alongside the knowledge of what's in your bank account. You can't use the management accounts without the bank account, of course, because as everybody knows in business, cash is always king. Hi, Michael. Yes, I'm recording this session. We're going to start with those reports and an understanding of what those reports are. And these are the reports that the accountant sends you at the end of the year, tells you to sign the accounts, whether you read them or fully understand them and then sign them and send them back. But these reports can be produced at any time. So the 2 reports that we're concerned with here, one is called the profit and loss account, and the other one is called the balance sheet. And they both are produced by the action of doing the bookkeeping during the course of the month and at the end of the month. So let me just give you a brief overview of what those 2 reports are. Now, time is very much a key factor here with regard to these reports. And the reports differ in terms of how time is seen with these reports. The profit and loss account is an account of the performance of your business during a specified time period. So you could say, I would like to see the profit and loss account for January of 2019, and you will see the performance of the business purely within that time period. Or you could choose to see it for a year, or you could choose to see it for 3 years or for 3 days. It's entirely up to you. So the profit and loss account is a periodic report. It is a report of the performance of your business during a specified time period. And therefore it ignores anything that occurs outside of that time period. And I think that's very important. The balance sheet, on the other hand, which is produced at the same time by the same actions of bookkeeping, is a snapshot of your business on a specific date. Okay, and it encompasses everything that your business has done up to that date in time. So you can have the balance sheet that is literally up to today if you were up to date with your bookkeeping, or you could say, I'd like to see the balance sheet of the end of December 2019. So at any point, the balance sheet is a cumulative picture of your business since the day your business started up until the date that you produce the report. So generally what happens is that when you do your management accounts at the end of the month, you finish off your month and then you produce your profit and loss report and your balance sheet, okay, for the month of April 2019, and then that will be telling you, generally it will be telling you what your performance was in April 19 of the profit and loss. It normally gives you a year-to-date performance of your financial year as well. And then it will give you the snapshot of the business in terms of the value of that business. And I use the word value carefully here. In terms of the value of that business as a snapshot at the end of that period. So the easy one to understand is the profit and loss. So I'm going to make a start with that now. I'm going to take an example of a normal trading business rather than the example of the property business. I think it's easier for you to see that first and then just apply that thinking to a property business. So I'm going to share the screen. And hopefully you can see that. Perhaps through the messaging, could I have somebody to give me some comfort that you can all read that okay? Does it need to be bigger? Yes, it's fine, I've got, thanks Anish. So the profit and loss, this is a business, and for the purpose of today, I'm generally going to be looking at businesses that are limited companies, but accounts apply to sole trader or partnerships in a similar manner. But this is a small business that's been established. It doesn't really matter what the business is doing. In this case, it is selling something. So it's buying stock and then it's selling stock. So it's some form of retail business here. And we're looking here that the profit and loss account for this business is for the month ending May 18. So we've seen the period of time, which is very important. And within that month, it has taken sales of £12,000. Now, the next line of the profit and loss is the line that directly relates to the income. So it's the direct costs of income and of sales, costs that would only be incurred if those sales are incurred, and costs that would not be incurred if those sales are not incurred. So the two examples of this that I put down, of which there may be many more examples, but two examples, common examples here, is that the cost of the stock has been sold because you've made the sales, but you've actually no longer got that stock, so you need to reduce your profit by the cost that you have incurred in that stock. And there's different ways of calculating that, which I won't go into today. So the cost of stock sold of £2,000. You've paid commissions to some people who've helped you to sell it. Obviously, because it's commissions, it's directly attributed to the sales. If you hadn't sold those sales, then you wouldn't be paying those commissions. So it's a direct related cost to the sale, which makes your total cost of sales of £3,000. And that brings you to the next descriptor, which you often hear stated is the gross profit. So you've made sales of £12,000, but your gross profit is £9,000 because it has directly cost you £3,000 in order to make those sales. And therein lies some of these phrases that you may have heard about turnover being vanity and profit being sanity. Of course, you know, the £9,000 is so much more important as a figure than the £12,000 because ultimately you were never going to make the £12,000 in the first place if it was always going to cost you £3,000 to make 12. So your gross profit then is the £9,000 that you see on the profit and loss report there. But then in order to run your business, you have expenses, and these expenses generally are not directly related to the sales. Basically, if you didn't sell a bean, you may still have these expenses. This expenses that we see here, simple examples, you've got salary of 2,800, rent of 1,200, utilities of 150, you've done some Google AdWords and that's cost you 200. You have something called depreciation, which I will come back to, which has cost you £300 as well. And I've highlighted that in yellow because I want to come back to that, which has given you a total expenses of 4,650. So the 9,000 minus the 4,650 gives you a profit in the period of 4,350. Okay, so relatively straightforward, easy to understand, the profit and loss account. And many people who read accounts, read management accounts, are very, very keen to see what their profit and loss report is and tend not to take too much notice of their balance sheet, which comes out really at the same time as the profit and loss report. But this is the performance report that everybody is really interested in and easily understood. I'm just going to come on to depreciation and come back to that, because depreciation is a cost to the business, which has come about because when you, at some point in the past, you would have bought some fixed assets. You might have bought machines, which are important to run your business, even the cash register, for example, some computers, furniture, or machines that are involved in actually delivering the service. And when you buy those machines, they don't appear under that expenses column on the profit and loss report. For example, that machine might cost you £20,000. Well, if we were to put it on that report, then you'd see that £12,000 of sales minus £20,000 of the machine's cost, and you're in a loss position before you've even looked at anything else. And it's not a true reflection of the performance of the business, because of course that machine will still be there outside of that period. However, over time that machine will become obsolete, will need replacing, and therefore the value of the machine over time diminishes. So the £20,000, at some point in the future, you're going to have to spend that £20,000 again, maybe 5 years down the line, in order to keep your business running and buy a new machine. So by the time you've thrown that machine away because it no longer has any use, we need to drip the cost of that machine into the performance of your business. Okay, and how much you drip in is something that you can agree with your accountant, or there's certain accounting standards as to how much. But the important thing about that is that the depreciation figure that you put into the performance figure, in this case, is a figure that will not directly influence your bank account at the end of that period. So it may have influenced your bank account negatively by £20,000 many months ago. However, within the period, the month ending to May the 18, already you're starting to see a difference between the profit and loss report and your bank account, and the difference in your bank account during May, because the profit and loss report is showing an expense of £300, which you will not see in your bank account. And I think that's a really key, important factor here in terms of the difference between running your business on a bank account based on the bank account alone, or running your business based on the management account and your bank account. Indeed, when we look at that sales report up there, it could be that some of those sales have been made on credit. So it could be that of that £12,000, only £300 of it could be in your bank account during May. The remainder could be coming into your bank account during June. So what we're seeing here is a much more accurate picture of the performance of your business than your bank account can show you. So that's the profit and loss account. So I'm going to stop that share now. I'm now going to share the balance sheet. So just bear with me. And I've sent this example balance sheet. And by the way, the example balance sheet that I've sent you is not the same as the profit and loss. So don't try to compare the two. I'm just using examples that are perhaps as simple as I can make them in order for explaining the understanding. So just bear with me while I try to share the balance sheet. Okay, so I've brought that up now, and this is something that you've also had already. I'm just going to have to mute somebody. Just bear with me, unless you can mute yourself. Appreciate that. That's good. Okay, so coming back to what I said at the beginning of the session, the balance sheet is a snapshot of time. It's, if the profit and loss is up to the end of April, the balance sheet normally comes out at the, is printed at the same time as at the end of April. But the profit and loss would be for the period of April, whereas the balance sheet is at that date. Okay, so on this particular example, it's 6th of April, 18. So this is a snapshot of the business on the 6th of April, 18. Okay, it's not a performance of the business, it's not a change within a period. It is literally the cumulative of that business since the beginning of time, since the beginning of that business itself. And what that shows you is three things. It shows you assets, it shows you liabilities, and it shows you equity. Okay. The assets are what you have as a business, or what is due to you as a business. The liabilities are what you owe as a business. And I'll come on to the equity, which is what the business holds in terms of what's being put into that business in the first place. I just need to go back. I'm sorry, there's somebody that needs muting in the background, unless you can find yourself and mute yourself. Yeah, I'm not able to do that while I'm sharing the screen. So if you can just check that you're muted, and please mute yourself, I'd appreciate that. In this particular example, the 6th of April, the bank balance was 470, and they had cash in the petty cash tin of £50. So those are the current assets that they have. Those current assets, sometimes known as liquid assets, are assets that can be used in order to deal with the running of the business. Okay, they are in terms of paying debts and such like. Those assets are usable, available to the business, and that's why they're known as current assets. On top of that, in the past, the business has bought a motor vehicle and has bought a printer. Now, you can't see in this very, very simple example here whether they actually bought those assets for the values that are shown. Let's just say, in the very simplistic form, they bought a motor vehicle for £4,500, which is why it's reading £4,500, and also the printer. However, if they bought that 3 years ago, then what happens is that depreciation figure that we have been talking about in the profit and loss will actually influence the amount that's on this report. So if they had bought the motor vehicle for £6,000 and in past years the depreciation was £1,500, then it would show the 4,500. So as you drip depreciation into profit and loss, then the fixed assets values in the balance sheet actually get reduced. So to the point where that fixed asset value over the 5-year period, if that's what you're depreciating, becomes zero then. Now, this is a very simplistic example. In many balance sheets that you read, you'll actually see the original price of the motor vehicle, and then underneath you'll see minus the accumulated depreciation. So you would see in more complex reports, you would see the motor vehicle there reading 6,000, and then underneath you'd see minus accumulated depreciation of 1,500, and then you would see the balance of 4,500 shown on the report in that manner. So you can actually see it in a slightly more detailed form. The current book value, and we're going to call it the book value of that motor vehicle, is 4,500. And then they've also bought stock, and as you can see, the stock underneath, which is to be sold, they have £1,500 of stock, which is the amount of stock at cost that has been bought and not sold. And of course, when people do stock counts, what they're doing is actually checking that the physical stock that they've got actually is the same as the amount that's written on this page. Why could it differ? Well, some could have been stolen or lost or damaged or so on and so forth. And therefore, that figure might need it to be adjusted by something called shrinkage, which is the amount that could be stolen, lost or damaged. But the interesting point about stock is that it's always shown on the balance sheet at cost. So if you have spent £1,500 to your suppliers on stock, then it will be showing on this as £1,500. What it doesn't show is the value of that stock that you're going to sell it for in the future. That shows in the sales when you sell it, but at the time that you've got it on hand, you've only got the cost of that stock in your business. You haven't got the sales value, the potential value of the stock in your business. Okay, so that brings you to a total assets position of 11,320. Then you have the liabilities, and just like the assets, you have the current liabilities, the liabilities that really do need to be paid rather quickly over the next month or two, so the liabilities that really are going to affect your bank account in the near future. And then you've got the longer term liabilities, which are agreed liabilities, such as a loan, motor vehicle, which will probably be paid at agreed intervals and will be reducing as and when it gets paid, as far as that's concerned. It could be that the loan was interest only, in which case the liability remains the same. It doesn't reduce until the date in the future that it is agreed that that loan will be repaid. So the accounts payable is basically the invoices that you've got that you haven't paid. Simply that. You may have bought the stock, or you may have an invoice from a utility company for electricity. You may have actually written the check for it, but it's not appeared in your bank account yet. So on this particular day, you may have said, yes, well, I paid that utility company, but the bank balance isn't reflecting that as of that date, 6th of April. So it's still a accounts payable, it's still a current liability until it's reflected in the bank account. I'm still getting somebody who needs to mute themselves. If they could possibly look at that and do so, I'd appreciate it. So the total of the, going back to the loans, if you have longer term liabilities, you have to add those. And so you can see that in this example that the total liabilities are 6,300, which means the net assets of that business is 5,020. Okay. The next situation, which I'm going to come on to a little bit more later, is the equity, where this business, when it very first started, the owner of the business introduced £5,000 of funds into the business, and of course that was then reflected in the bank account up here. The director has drawn £130 out, has has earned £150 in profit, and therefore the business equity is £5,020, which is also reflected here of the net assets. So the net assets is £5,020 there. On paper, that's the value of the business. On paper, the business has a net asset value of £5,020. And as you can see, the funds introduced into the business were £5,000, and so that's why the business has some net equity value of £5,000 plus the £20, which is the money that's been made. But of course, it's unusual for any business to sell for the net asset value, because at the end of the day, a business will sell based on a market. And the market is like any market. It's a demand and supply market, and it's to do with the buyer and the seller and the price that could be agreed. But the net asset value is a very, very important part of understanding what the value of that business is. Because if you were to agree that a business did have a value of I don't know, £50,000, and you're prepared to pay £50,000 for somebody's business, but then you see that it has liabilities that far exceed its assets, then you would have to actually then reduce the amount you agree to buy that business for by those that net asset position, if it's a negative net asset position. Because after buying the business, you will then know that over the coming months that those liabilities would have to be paid. So you would have to then pay out those liabilities. So many people buy businesses with quite considerable liabilities, but that is ultimately reflected in the price that they pay for the business, as far as that's concerned. So we talk about the equity, we talk about the net asset position there being the value of the business, a book value of the business. But of course, it's not a value that is attributed to any market sale or market agreement that is made. But it is a very, very important factor in when you're looking at a business. If you're thinking about whether or not to buy or whether or not to sell a business, then of course that figure is very, very important. So I'm just going to stop the share on that and come back. There we go. So if there is somebody I can mute. No, I think I'm all right. I think everybody's muted now, so that's good. Here we go. It's Michael. There we go. So we've got to that position there on equity. Now, I do want to talk about a little bit about starting a company. And introducing equity into a company and how that can be reflected in the company. So I'm just going up to my notes at the moment. So I'm going to just share one more screen with you. So we've got a situation here, hopefully you can all see that, where you start a new company, and when you start a new company, you go into Companies House and you have to actually create or generate the number of shares that you want, and it's basically, in this example, we've said we're going to create 100 shares at £1 per share. And when you do that, you physically write a check and you to the company, you put it in the company bank account, and the £100 is introduced to the company. Now that £100 is introduced to the company as what's known as equity, which basically means that the company has a net asset value, an equity value at that moment of £100. Okay, so if you then decide, oh, well, that wasn't a very good idea, but somebody else wants a company, they can buy it off me. I haven't even done any trading at all. Then they can give you £100 for that company, and they've got a company with £100 in the bank account. So that's where we look at the book value of the company, the equity value of the company being the net assets, because, you know, £100 is in there. So we have what's known as capitalized the company to the value of £100. Okay. But of course, the company might need more than £100 to get itself trading and get itself up and running. So you might then decide to introduce another £1,000 into the company. And you'd be introducing that £1,000 as a loan to the company, a director's loan, as it's known as. Okay, so you've got on your balance sheet in the bank. Just change that. So you've got in the bank, you've got £1,100 and it breaks down basically as a director's loan, which is a liability that the company has, because the company has to pay that back to the director in time, of £1,000, and equity of 100. So your bank account is reading £1,100, director's loan is reading the liability of 1,000 and an equity of £100. Now you could choose, if you wanted to, if you needed your bank balance to read £1,100 in order to get going, you could choose to capitalise that company at £1,100. You could create shares that were worth more than £1 each, or you could create 1,100 shares at £1 each. That's a choice that you have. Okay. Now, rather than going into too much of the arguments, why would you do one and why would you do the other? The most common way is to capitalize your business at a very low amount. Let's keep it to the 100 shares at £1 each. Okay, and then introduce funds by means of a director's loan. That generally gives much more flexibility for the future in terms of how you might want to draw money back out of the company when it's making money. Okay, so you can draw that money out once the company is up and running and it's making profits. You can take back that director's loan without any impact on tax or any impact. It simply is the repayment of the loan back to the director. If you had introduced the funds as equity in the first place, then there's more complexities as to regards to how you can then draw that money out as a director. And there are tax implications of that. But of course, the difference being is that if you introduce just the £100 of equity, then the business has only got that equity value of £100. If you introduce the £1,100 as equity, then the business has got a much higher equity value. This becomes relevant if further down the line, more shareholders want to come and get involved in the business. And therefore what they can do is they can introduce equity into the business by investing in the business, as introducing equity further down the line. So it becomes much more relevant as the business becomes more mature and wants to take itself onto the next stage. Okay, so we've got a brand new company, nothing's happened to it at this point, and then it makes its first trade, and I've put in brackets, it's producing piano lessons, so it's very, very simple. There's no stock involved, there's no purchase involved, and it sells a piano lesson for £80. Then the bank balance there becomes £1,180, and the liabilities of the director loan remain, so it has a net assets now of £80. So what you see is that every day the activity of that company is either improving or reducing the net asset value of the company. The performance, positive performance of the company then grows the net asset value of that company. So I'm just going to stop that share now. Okay, so basically, I'm just now going to go back to some of the questions, and then I'm going to bring the thing open for discussion where we can all come in and just discuss what I've said so far. I do appreciate this is pretty basic stuff to begin with, but that's the plan, and we will just work on it from there. The only other thing I would say with regard to bookkeeping, before we go into the questions, is that every single transaction that you do in a bookkeeping software package, every time you enter an invoice or sales or reconcile bank, every single transaction is reflected in those reports. It's reflected in the profit and loss and or the balance sheet, okay? And it's actually reflected twice. Every single transaction is reflected twice in the profit and loss and the balance sheet. It may be it only is reflected in one of those reports, or it may be in one and the other, or one or the other. And we'll come on to that as the sessions go on. But that's where the term double entry bookkeeping comes from, in that every single transaction is reflected twice. So if we looked at that £80 sale of the piano lesson, in the profit and loss on the sales, you would see £80. And in the balance sheet on the bank account, you would see £80 in the bank account. So you're seeing that £80 twice, okay? And that is an important principle of bookkeeping, and why it's called double entry bookkeeping. So Cash, just having a look, are you going to record this session? I said yes, it's being recorded, so we'll be putting that out on YouTube with a restriction on those that can watch it, being those that are Unity members. Cash has said, a quick question, in the consultancy business, things like food, travel, telephone, etc., would that cost into the cost of sales or expenses, please? It would be expenses, Cash. The cost of sales in a consultancy business would be if another person had recommended you and you had prior agreed that 10% of your sales will be paid to that other person in a commission, okay? That would be a cost of sales because it's directly attributed to the sales that you make, and you can't change that. But your food, travel, telephone would be in the expenses side. From Vinny, how does this help with someone who has an investment property portfolio than a trading business? Of course, that's the question that's on all of our minds. And I think it was important that we start with the trading business, and you can then start to shift your mindset from that basic principle of a trading business into a property investment business. How does that help somebody who has an investment property portfolio? So if you have an investment property portfolio, if we just consider that performance, that profit and loss, it's very, very similar to a trading business. Basically, you have rent coming in at the top, which is your sales. You may have commissions, which are a direct cost of sales. That could be if you had, for example, an agent that was taking 10% of your rent. Okay, that would be a cost of sales, and then that would bring you to your gross profit. And then beyond that, you'd have your utilities, you'd have your potentially you'd have depreciation on some fixed assets, you'd have your rates bill, your council tax bill, you might have mortgage interest to pay, and then you would come at the end of that period with your net profit. Okay, so it's a very, very direct relationship with a property investment business to a trading business. It's very, very similar from a point of view of the profit and loss. But let me talk a little bit about that depreciation figure. The depreciation figure would be in respect of fixed assets you may have bought for that property, such as furniture. It may be in respect of fixed assets you have bought to run that business in terms of your computer and your home office and so on and so forth. Okay, but depreciation does not show on the buildings. Okay, so when you then have a look at your balance sheet and you have a look at your assets, you will have assets which are buildings, and you will have assets which are depreciable assets, such as furniture, such as computer equipment, and so on and so forth. But your buildings do not depreciate, so they do not follow those rules, and you do not have this depreciation happening. Your buildings figure will remain on your assets as the cost of the building, okay? Some accountants, and that's where in accounting rules you do have two different options. There are situations where those buildings will be periodically revalued based on the market value, and they will then be adjusted on the balance sheet to the new market value. Or there is the opportunity to leave the buildings figure at the price that you paid for those buildings on your balance sheet. It's two different ways, and it doesn't matter too much how you do that, so long as you're understanding of that situation. So basically, very, very similar to property investment business, okay, on the profit and loss side of things. On the assets side of things, then basically the difference might be in the assets that you have your buildings fixed asset, and then which is non-depreciable, and then you have your depreciable fixed assets that sit behind there. Now, I've basically come to the end of the points I've noted that I want to talk about today, but I just want to sort of finish off with a view to the next session, and which we're going to talk about more about the double entry element of bookkeeping and what's happening when you're actually writing a transaction. And the key things here are the date of the transaction, okay, because of course it's really important for the period of the profit and loss and for the period, the fixed date of the balance sheet, that the date of your transaction is accurate. Okay, so the key pieces of information that we're using when we're entering information into our bookkeeping is the date of the invoice. We also then enter the payment due date, the supplier, and the description. But then what we do is we attribute that value of that transaction to an account. And it's whichever account you attribute that transaction to as to where that transaction will appear on the profit and loss and or on the balance sheet. Okay, so what we do is we split, we have a chart of different accounts, and you can say if it's a sales, you would put it to the sales account. Okay, so it's really important from an entering point of view that the transactions are properly attributed to the right account. And then the other important factor that when you're entering a transaction is obviously that you get the value right, that actually the value that you're entering in as a transaction is the true value that is going to actually leave the bank account and pay, or go into the bank account if it's sales. So we'll be looking at that in the next session, and then in the third session we're going to come on to talking about the program XERO itself and actually getting some confidence in actually adding the transactions into the XERO. And along the way, people who already have XERO, or people who might be deciding whether to actually subscribe to XERO or not, outside of these sessions and through dialogue, what I can do is I can assist people with the establishment of the XERO accounts. So for example, if you currently have XERO and you have a property business, but your reports are not splitting it up into the individual properties, that's something that we can do. We can arrange that your profit and loss report can actually be split up into each individual property, or your buildings figure on your balance sheet can be actually split into each individual property. Your liabilities, which might be your mortgage interest, could be split into each property. So there's ways of actually showing this in XERO, which I can talk about in between these sessions by just literally dialogue, by dealing with the questions and the answers from that point of view. I'm just looking. So if anybody has any comments or questions, anything they want to add, anything you want to correct me on, perhaps. Can you perhaps unmute yourself at this stage and come in? Thanks, Vinny. That's good feedback. It's difficult for me to know whether or not this is of any help or whether I'm incoherent or otherwise here. If anybody has any questions, then what we're going to do is, if you like, officially close the session now, but turn it more into a chat session. So if people want to come in and join in, we'll leave you up, we'll leave your video up and running. And if there's anything that you want to expand upon with questions at this stage, or if there's anything that you didn't quite understand, then please come in at this stage, because those people might want to leave the room, but we'll just keep the others in the room for as long as you need to be in the room in order to get the clarity of understanding based on what's been said so far. So that's where we are. Do we have any questions? Anybody wants to come in and chat?
Rupert, hi, thanks for that. That's brilliant. Can I ask a quick question? That if our mortgages are on repayment mortgages, how do you account for the interest-only bit and the repayment aspect of it on the paperwork, on the numbers?
Okay. Is it Vinny, by the way? I'm going to bring you on as a video if it is. Yeah. Was that Vinny that was asking? Yeah.
Yeah, it is. That's right. Yeah, it is.
No, I recognise your voice, but I couldn't see who was speaking otherwise. Yeah. So the question is basically, when you have a repayment mortgage, how does that reflect? And that's a really important question, really. It's so important with regard to these bounce back loans that are going on at the moment, because cash flow at the end of the day is king. So for example, if you had a loan, an interest only loan, where you were paying £200 a month in interest, then the profit and loss account would show that £200 as an interest payment under expenses. So you'd have £1,000 of rent coming in, you might have £100 of commissions going out, so you have a gross profit of £900. And then you'd have to pay the utility bills, perhaps, you'd have other costs, you'd have your fixed overheads on your home office and things that would go out there, and you'd have mortgage interest of £200 going out, and you might have a net position of £350. So you're pretty happy about that. You've got your property, you've got your buy-to-let property, and it's earning you what you call cash flow of £350 a month. Okay. But what if that mortgage is a repayment mortgage? You may, on top of that, be paying £400 a month out of your bank account in repaying that capital. And that won't appear on that profit and loss. So that profit and loss report would still only show the £350 profit that you're making on that property. But £400 is going out. Did I say 400? I can't remember what I just said, but let's say 400 is a good example. £400 is going out to the lender in repayments. So your bank account now is minus £50. So you're going to hit a wall. And unless you keep actually injecting money into that business is going to fold. It is going to go into liquidation, because it hasn't got enough money in the bank account to support what its activities. Okay. And the way it's reflected in bookkeeping is that's reflected in balance sheet. Because let's say on the assets side of the balance sheet, you have a building value of £100,000, okay, which will be fixed and stay at £100,000 on the balance sheet for the sake of this question. And then you go to your liability side, and you borrowed £80,000. So on day one, that £80,000 underneath the balance sheet would have shown as a liability of £80,000. And then a month goes on and £400 is repaid. Okay, so in a month's time, that 80,000 figure is reduced by the £400,000. Okay, so but let's go back to the assets side of your balance sheet. At the top of the asset side of the balance sheet is your bank balance. Okay, so your bank balance is also reduced by that £400. So your bank is reduced on the asset side by £400, and your liability is reduced on the liability side of your balance sheet by £400. So the net position of your balance sheet doesn't change. Okay, the net assets is the same, but there's a shift there. You have a lower liability and you have a lower bank account. And of course, cash is king, so it's really important that you have sufficient money in your bank account in order to feed that. Now let's just come back to that profit and loss account and say that what if that profit and loss account was reading £600 rather than 350 as a result of your trading activities? Well, then arguably you can afford that £400 of capital repayment because your profit and loss is feeding into your assets, because your profit and loss is reflected in an improved bank balance. Okay, so your bank balance is then showing a higher figure. How is that? Can I help further? Do you get that?
Yeah, no, that's brilliant. That's
Yeah.
wonderful. I think the other intricacy is that technically every month on a repayment mortgage, the interest you pay goes down. So you know, it's about calculating that and putting the right number in, and technically the amount that you actually repay off the loan every month goes.
So it's clear that running your business, many people run their business purely on the bank account, and I would describe that as running blind. But it's not an alternative to run it purely on management accounts. You know, the management accounts are running with sight, but the bank balance is and the bank balance is still the most important thing that you run your business by, because ultimately, if you haven't got the money in the bank, you can't make those payments. And obviously, the bank balance alongside the balance sheet, if you're looking at your current liabilities, if your current liabilities are higher than your bank balance, then you have to start looking at the breakdown of those liabilities and deciding which of these creditors you're going to pay when. Because you might be saying, well, look, you know, I know that in 2 weeks' time I've got this amount of rent coming in, therefore I'm going to pay those creditors now, and I'm going to pay the other creditors after the rent comes in. So you're still running it by your bank account from a daily point of view. But what the profit and loss and the balance sheet is doing is actually saying, look, if I stop trading right now, I've got somehow all of those creditors have got to be paid. So that's the reality check. Okay, you might have 10,000 in your bank, but you don't use that 10,000 to buy a holiday if you've got 12,000 of liability, of current liabilities. That's where the difference between running blind and running with open eyes are, by using management accounts. Any other questions to come in on this? When is the next one, Ian? Ian, I'm going to ask the group about that, but where we are today is Thursday. I'm quite happy to do one over the weekend, so I'm going to make a suggestion to the group. I've got everybody on an email group now, so I'm going to send an email after this and get some feedback, and then based on that feedback, I'm happy to do the next one and plan the next one. So have a think about when is a good time for you to tune in. Mornings are quite good for me because I'm a little bit fresher, but I really don't mind. So maybe Saturday. Sunday I've got obviously the cafe, which tends to go until about 12:30, so perhaps it's going to be Saturday. Monday would be good. I could do Saturday and Monday, so I'm fairly flexible as to when to start the next one, and I'll send an email out at the end of this session to get some feedback before making a decision on that or making a proposition on that. Any questions on understanding from today's session?
It's just a quick question, Rupert, if I could, very quickly. Within the property business side, the mortgage interest, the management fees, and hi, Rupert.
Hi, Cash. Hi.
Hi. So I'm just looking at. I use XERO, and while you were talking, I was just going through our management, the profit and loss accounts, and there are a few entries which we have classified as administrative cost, like the management fee, the mortgage interest, and a few other things. Do you think they would go under cost of sales?
No, absolutely not. They don't go under cost of sales because you would have that cost, okay, regardless of whether you made any sales or not. And that's the thought, that's the trigger thought, the decision maker, if you like, as to where do these go. If that cost was there, even if the rent wasn't paid, then it's not a cost of sale. Okay, it's only a cost of sale if it's absolutely directly attributed to the sale itself. And the best example in a rental business is an agent fee, because agents often have an agreement where they will take 10% or 12% of the rent. So if there's no rent, they don't take any money from you. So the rent, the commission for the agent would be a cost of sale. I can't think of another cost of sale, if I'm honest. So I would say that everything else would be falling under the expenses line from that point of view. Now, of course, when you first set up XERO, for the benefit of the rest of the group, many of these accounts are already established. You know, they're common accounts that common businesses use. And the three accounts, the accounts that start with the number 3, tend to be cost of sales accounts, and the accounts starting with the number 4 tend to be direct expense accounts. And you can create as many accounts as you wish. So you can make your XERO as complex with the greatest breakdowns that you can establish, or as simple as you like. You know, so if you only wanted to have one account called cost of sales, you can have that, and you just call that cost of sales, and you put everything that's cost of sales into that account. You could have one account that just said expenses, and you put all expenses into that account. How complex you make it is really dependent on, you know, how much information do you want to derive from it, and therefore if you want to split your expenses between utilities, council tax, mortgage interest, and you want to be able to see those breakdowns, then you obviously have more accounts in that regard. But for example, utilities, do you want to see one account called utilities, okay, or light, power and heating, I think they call it, or do you want to see gas separate to electricity, okay, separate to water? You know, it's your choice. You can create those